Hello everyone. In this stage, we are going to cover the ratios we are going to use to forecast our free cash flow to the firm and also to prepare pro forma financial statement. Let us start. So here you can see we are going to calculate some ratios for the related to operations and then spontaneous current assets and spontaneous current liabilities. Um, and then we're going to also calculate our capital structure, and then we're going to also estimate our cost of capital, and then we are going to also calculate our dividend growth rate. All right, so let us do so. And then here you can see first we start with sales growth rate. So we calculate sales growth rate every single year starting from 2018 in this case. We cannot calculate sales growth rate for the year 2017 because the sufficient data to do so are not available. Then every year you can see we calculate cost of goods sold as percentage of sales. And make sure you get all the ratios in positive number. Then operating expenses as percentage of sales again. Then depreciation as percentage of net PPE. The depreciation expense over net PPE. And then cash as percentage of sales. Again, cash as percentage of sales. The same way, accounts receivables as percentage of sales, inventory as percentage of sales, net PPE as percentage of sales, accounts payables as percentage of sales, and then the effective tax rate. So effective tax rate is provision for tax over earnings before tax. So just calculate it for all the historical years. In this case, I have data for 2017 to 2021. So I calculate all of these ratios for these years. Now, for the future years, you need to forecast. Now here, same. I want to take the average of the last 2 years. Remember, this is all discretionary. You need to use your judgment to find out what should be your sales growth rate. Now, for demonstration purpose, say I expect that sales growth rate in the year 2022 will be the average of sales growth rate in 2020 and 2021. You may have a very different opinion. You may say, okay, I expect the sales growth rate to be the average of 2020, 2018 and 2019. So whatever your expectation, just apply it here. So then I expect that the sales growth rate will eventually go down and settle at 10.4% in the year 2026. All right, the same way, you make some forecast for cost of goods sold. So it depends on your expectation. Then again, for operating expenses as percentage of sales, you may say, okay, I expect them to be average of the last 3 years. Some may say, okay, I expect it to be the average of the last 5 years. It is up to you. Then the same way, you're going to form some expectation for depreciation, then cash to sales and other ratios we have. So just form your expectation. So I have my expectation here. You can see for all the future years. And the reason here you don't see any formula, because once you run the scenario analysis based on these numbers, all of those will automatically become text, become, you know, non-formula items. That means like specific number, no formula. Anyway, but once you start, whenever you start, you should have the formula here, because the formula should show, okay, how you get this number. All right, next, percentage of debt. So percentage of debt, here you can see total debt divided by total capital. So total debt should include current debt and long-term debt, and then you total capital should include current debt, long-term debt, and then total market value. So this is how we get our, you know, percentage of debt. Again, as you can see here, the same way, we don't have any preferred stock here, so we are not worried about that. Then percentage of common equity, common stock. So the rest should come from common stock, as you can see here. Now rate on debt. So now let us see what is our interest expense. So our interest expense was this, and then we pay interest over our short-term debt and long-term debt. So this is how we get our rate on debt. Rate on preferred stock, we have nothing, and then we know our cost of equity we calculated in this cost of equity tab. All right, then rate on cash and cash equivalents, we have some interest income. So here we get our interest income over our cash and cash equivalent and investment accounts. So we have here long-term investments. Do it for every single year. Then dividend growth rate. So calculate dividend growth rate starting from 2018, and then again based on the values of these ratios in the historical years, you are going to form your expectation for the future years. And then again, this forecasting is very much discretionary. All right, now in the next step, we are going to forecast our operation. So we copy our sales number from the from the income statement for the historical years, and then for the future years, you can see we are applying all the ratios and rate we forecasted here. So we forecast our sales growth rate to be 19.4%. So we are growing our sales in the year 2021 by 19.4% to get our sales revenue in 2022. The same way, you can see we are applying this sales growth rate to get our sales number in the future years. Then let us now calculate our spontaneous operating assets and operating liabilities account along with our net PPE. Let us name it operating assets, operating liabilities, and PPE. Okay, now here you can see we expect our cash to be 18.1% of the sales in the year 2022. So we are applying this ratio over the net sales to get our cash amount. The same way, we expect our accounts receivable to be 1.7% of the sales amount. So again, you apply these ratios here. The same way you calculate your inventories. The same way you are going to calculate your net PPE. So you expect your net PPE to be 11% of the sales you forecast. And then you are going to again apply your payables to sales ratio you expect in the year 2022 over your sales revenue forecasted to get your payables and accrued expenses. All right. So you are going to do the same process for all the other years. The same way you calculate your operating income, and then to do so you need to know your cost of goods sold. So here you can see your cost of goods sold is expected to be 58.7% of the sales revenue. Then your operating expenses is expected to be 8.4% of the sales revenue in the year 2022. And then your depreciation. So your depreciation is expected to be 29.3% of net PPE. So this is different. So you apply this depreciation rate over the net PPE in the year 2022 to get the depreciation in the same year. Then you get your EBIT. So EBIT is the difference between net sales and all the operating expenses, including depreciation. So you get your EBIT. Then net operating profit after tax. So apply the tax rate of so calculate EBIT net of tax to get your net operating profit after tax. Now we are going to calculate our free cash flow. To get our free cash flow, we need to know our net operating working capital. So net operating working capital, you can see here, it is the difference between spontaneous current assets and spontaneous current liabilities. So we did it for every single year. And then total net operating capital. So total net operating capital is the sum of net operating working capital and then net PPE. So you can see that is exactly what we did for all the other years. Then we are going to calculate our free cash flow to the firm. So free cash flow to the firm is the difference between net operating profit after tax and changes in net operating capital. So here you can see net operating profit after tax minus the changes in net operating capital. This is how we calculate our free cash flow to the firm every single year. All right, now let us calculate our weighted average cost of capital. So to get our weighted average cost of capital, we apply WACC formula. And then remember, we need this WACC for the forecasted years. We don't need it for the historical years because we are not going to consider free cash flow of the firm in the historical years to get our intrinsic firm value. All right. So in order to do so, apply the weighted average cost of capital formula. So you can see here, we calculate, we apply the weight of debt over the cost of debt, and then we actually take the net cost of debt net of the interest tax shield, which is 1 minus tax rate, then plus our weight for preferred stock, and then our rate on preferred stock. We have nothing actually here. Then our rate on cost of equity, and then our percentage of common stock we have. So this is how you get your weighted average cost of capital, and then we are just interested to see our free cash flow to the firm for the growth rate in the free cash flow to the firm in all the years. Now you can see in the very last year, your free cash flow to the firm growth rate is equal to the sales growth rate here, and there is a reason. So sales growth rate remains the same in the year 2025, 2026, and all the other ratios also remain the same in these 2 years. So eventually, in the very last year, your free cash flow to the firm growth rate should be equal to your sales growth rate. Now, terminal growth rate, in this case, I put 6%. This is very much discretionary. You can put something from 3% to, I would say, 6 to 7%. Here I choose 6%. Even if you choose 4%, I don't see anything wrong here. So the idea here is terminal growth rate is the growth rate at which you believe the company will grow for indefinite time period. And usually we assume terminal growth rate should be equal to long-term GDP growth rate of a country. And then here, the idea is a company cannot beat the economy consistently for a long-term period. So eventually the company will become matured, and its growth rate will depend on the economic growth rate in a country. All right, now you are going to calculate your terminal value. So terminal value formula you can see here. free cash flow to the firm times 1 plus growth rate over the difference between WACC and then terminal growth rate, and then calculate present value of the terminal growth rate. Remember, you get this terminal growth rate at the end of 2026. So we want to take the value from 2026 to the end of 2021. In order to do so, we need to discount this terminal value. So you can see we are discounting this terminal value by the weighted average cost of capital, and then the time period we cover here is the time period from 2021 to 2026. So this is how we get the value at the end of 2021. Then present value of the free cash flow to the firm. So you also have some free cash flows beside our terminal free cash flows, right? You are going to discount those forecasted free cash flow to the firm using the weighted average cost of capital to get the net present value of those free cash flow to the firm at the end of year number 2021. And then you are going to sum up all the investments you have. So here you can see you have the investment here for the very last year, and then value of operation should be the sum of the present value of the terminal value, and then present value of free cash flow to the firm, and then investment. Next, you're going to reduce your value of operation by all debt and preferred stock amount to get the estimated intrinsic value of equity. So your total debt in the very last year is current debt and then long-term debt, and then you have your preferred stock here is 0, and then once you reduce your value of operation by these two accounts, you're going to get intrinsic value of equity. Then you're going to divide it by the number of shares to get estimated intrinsic value. So that's all for this part. Thank you.